Thank you, Taxmann, for giving this opportunity to speak to all of you through our virtual webinar. And thanks to all participants for joining this webinar. Section 28(4), benefit or perquisite arising in the course of business, and introduction of Section 194R for the purpose of deducting TDS from last year has raised many challenges to the profession. Something which was reasonably understood as a professional, that what could be treated as benefit and what could be treated as perquisites, and what could be treated as profits and gains of business or profession based on interpretation of law and the jurisprudence, has undergone a substantial change, particularly after the amendment made to Section 28(4) and 194R from Finance Act 2023. And therefore now, as a professional, we all need to understand and appreciate that what could be the widest gamut of what is benefit, what is perquisite, what is arising from the business, and whether the principles of 28(4) and 994R would be same, or if you read Section 194R, it does not refer Section 28(4). It borrows the language of 28(4), but it does not refer 28(4). And therefore, can somebody argue that it may be a benefit or perquisite for 28(4), but it may not be subject to TDS, or a vice versa? And that is also one question which all of us would have from the professional perspective. Let me, in next 45 minutes, summarize generally the principles of law and what I would believe based on certain practical situation. But before which, let me go to certain basic principles of law on what is income and what is profits and gains of business or profession. The Constitution, entry 82 of list 1 of the 7th schedule, gives power to the government to tax on the income other than the agriculture income. And therefore the word income, what we understand for the purpose of income tax, derives its power from the Constitution. And then you have certain judicial precedents to say that it has to be interpreted in a widest possible manner. And therefore, if you go to Section 2, Clause 24, it says it is an inclusive definition. And therefore, something which is not defined, but which could be treated as income based on the general principles and commercial principles of the transaction, then that also could be treated as an income for the purpose of Income Tax Act. Section 2, Clause 24, Roman 5D, also specifically refers to 28(4) as an inclusive definition, and therefore benefit or perquisite arising from the business is a part of income for the purpose of Section 2, Clause 24. Then when you go to Section 28 as profits and gains of business or profession, it says, subsection 1, that the following income shall be chargeable to tax as profits and gains of business or profession. And then you have certain list of items which are taxable as profits and gains of business or profession. And subsection 1 is a general provisions that any profits and gains arising from the business is chargeable as profits and gains of business or profession. The earlier section, 28(4), was inserted by Finance Act 64, and a circular was issued on July 64 to explain that what was the objective of this particular provision. And at the relevant point of time also, if a particular benefit or perquisite is given in kind, then that was also taxable under Section 28(4). It may or may not have a TDS obligation, but it was taxable. And therefore, hypothetically, if I am a FMCG company and if I have a sales promotion scheme that if you buy these particular products, if you buy this quantity of goods, I will give you a gold coin, I will give you a TV, I will give you a motorbike. Then these items as a part of sales promotion expenditure were always treated as a business expenditure under Section 37(1). But the question was, is it taxable in the hands of the recipient also? And logically, since 64, the answer would be yes, that this item will always taxable in the hands of the recipient if it is arising from a business. And in a commercial world, if it is from a B2B, a dealer, distributor, stockist, retailer, would normally be taxable in their hands. But in practice, we know that this was never accounted for in the books of accounts. In majority of the cases, neither it was offered for taxation to the recipient of the taxation. And this was one of the concern of the government, that when a payer is claiming this as a business expenditure, but the recipient is not offering this for the purpose of taxation, and therefore there is a leakage of tax in the hands of the government. And therefore, the original objective of this particular provision was to tax such kind of benefits or perquisites which are mainly given in kind. And therefore, if I dissect earlier Section 28(4), it was a benefit or perquisite. It should arise from the business and it should be whether convertible into money or not. And then series of judgments of the High Courts and Supreme Court is interpreted that if it is for a cash, then 28(4) should not apply. And therefore, logically, it was mainly covered for the purpose of the benefits of perquisites which are given in kind. Now, the first question which would arise for all of us, what is benefit and what is perquisites? These are not defined in the Income Tax Act. The word perquisite is defined for the purpose of Section 17 as a salary income, any privilege or benefit given in addition to the salary income. Whereas benefit, general dictionary meaning is any advantage, profits, any incremental privilege, any incremental incentive, benefits, etc. given in addition to your normal contractual obligations. And therefore, if a particular amount is given in addition to a particular thing, then it could be treated as benefit or perquisite. And therefore, there are some judgments of the High Courts and Tribunal where they have interpreted what is benefit or perquisite. And there are two judgments which are there on the slide. I'm not going to read the judgments in the presentation. But some High Courts and Tribunal have interpreted these in the past as what is benefit or perquisite. And for the purpose of perquisites, we know Section 17 and also the rules under Section 17 for the purpose of calculation of what could be treated as a perquisites. The most important concept, in addition to benefit or perquisites, is arising from the business. And therefore, again, if you go to the general judicial view, it should arise from the business. It should have a proximate cause, a real, immediate, and not illusory or imaginary. If it is a very, very remote connection between a benefit or perquisite and a business, then it will not be treated falling into Section 28(4). But if it is arising from the business, so the example which I gave of an FMCG, a distributor is given a gold coin or a TV for the purpose of performance of buying certain goods, then it has a direct or a proximate connection between the purchase and sale transaction, which is a business transaction, and getting a benefit or a perquisite. At the same time, recently somebody was asking me that a company gave an iPad to all their directors free of charge. The question is it subject to 194R? Is it subject to section 28(4)? Now, from a recipient perspective, it is not in the arising from the business. It could be treated as a perquisite under section 15, 16, 17, or it could be subject to is TDS under section 194J for a non-executive or an independent director. But again, question is it a perquisite? Answer could be yes, because it is a privilege, a benefit given to a director in addition to one's role of performing as a full-time director or an independent director. But then, is it falling in 28(4) or 194R? The answer would be no, that it is not arising from the business. And therefore, this is one important concept which all of us will have to bear in mind when we interpret section 28(4) for the purpose of the taxability under section 28(4). The other third limb of 28(4), which is an earlier 28(4), is whether convertible into money or not. The Supreme Court in Mahindra took a view that a write back or a waiver of a loan or a waiver of unpaid amount towards purchase of an asset is akin to a cash, and therefore it is not taxable under section 28(4). The same principle was taken by a CIT versus Alchemic way back in 1975. But before this judgment, the two judgments of the Delhi High Court and Madras High Court are relevant. The Madras High Court took a view that if I write back a principal amount of a loan, whether a term loan or a working capital loan, then both will be treated as a taxable under section 28(4). And the Madras High Court took the principles from the Supreme Court judgment of TV Sundaram Iyengar, which I will take up a minute later. And therefore, if I have taken a bank loan of 100 rupees, or if I have taken an unsecured loan from the relative of 20 rupees, and for any genuine bona fide reason, I am not able to repay that loan, then that amount would be taxable as business income under section 28(4). The Delhi High Court slightly took a different view to say that if I take a term loan, which has been utilized for the purpose of purchase of a fixed asset, which is a capital asset, and therefore that amount would not be taxable because it is on capital account. But write back of a working capital loan, which is on a trading account, is taxable under section 28(4). Now, what was the rationale of Delhi and Madras High Court? The rationale was coming from the Supreme Court judgment of TV Sundaram Iyengar as far as the trading transaction is concerned. And the Supreme Court in TV Sundaram Iyengar, the facts were that the company had taken a distributor deposits from the distributors. And after a few years, the distributors were not available. And after certain years, this amount of deposit was not refundable. And therefore, the company wrote it back, that amount of fixed the distributor deposit, to the profit and loss account. And the question was that whether these distributors or customers' deposits is taxable or not. And the Supreme Court said that it was treated as a deposit and was on a capital nature at the point of time when it was received. By influx of time, the money has become, as is its own money, it became a definite trading receipt or a trading surplus. And therefore, it becomes a taxable income under section 28. These principles were taken and considered by the Delhi High Court and Madras High Court while taking this view. But this Delhi and Madras High Court now has been specifically overruled by Supreme Court in Mahindra and Mahindra to take a view that write back of a principal amount should not be taxable because it is a cash transaction, and any transaction in cash would not be covered under 28(4). Interestingly, Gujarat High Court, in the case of Chetan Chemicals, went a step further. The Gujarat High Court took a view that if I have an unsecured loan from a third party, which is not payable and which is returned back to profit and loss account, whether it is taxable at 28.4. And the Gujarat High Court took a view that one, it is not taxable because it is a cash transaction and not in kind, and therefore it is not taxable. And also, it says it is not arising from the business. And since I am not in the business of borrowing and lending of money, it is not arising from the business. And if it is not arising from the business, again, it is not taxable under 28.4. Now, the second principle, that I am not in the business of borrowing and lending money, and therefore it is not arising from the business, becomes a very, very important argument after the amendment, which we'll look at slightly later. Now, Finance Act 23, which amended Section 28.4. And the memorandum explaining provisions explain that intention of the legislature was always there, that it is taxable whether in cash or in kind. However, the courts have interpreted that the cash transactions are not covered. And therefore, to clarify, we are amending this provision prospectively from assessment year 24-25. Sometimes, as a professional, I always believe that when the draftsman and the lawmakers, including the CBDT, when they are contemplating to make this provision, how would they know that what happened in 1964, whether they would be able to connect with draftsmen, they would be able to connect with CBDT people, what was there in your mind? Or is it an artificial intelligence that they would know what happened in 64? And this is perplexed question to me everywhere. Whenever government says that we always intended this, but we missed out this. Now the courts have interpreted this, and therefore we are making this amendment. And therefore, this is again a classic example that when you are making these changes in 23, what happened in 64, how would you know that this was an intention? Anyway, that is what the government has clarified in the memorandum article provision. And now the law is that the value of any benefit or perquisite arising from the business or excesses of the profession, whether convertible into money or not, or in cash, in kind, partly in cash, partly in kind. And therefore, earlier we saw the three limb of 28.4. Now the fourth limb has been inserted to say in cash, in kind, or partly in cash and partly in kind. And therefore, by implication, the honorable judgment of the Supreme Court is overruled by virtue of this amendment. At least we are lucky that it is prospective, and they did not say that we will amend this retrospectively from 1964. But the law has now been amended prospectively, that even a cash benefit or in kind or partly in cash and partly in kind would also be taxable for the purpose of this. Let me take a few practical situations. One, a waiver of a loan post-amendment and post-overruling the Supreme Court judgment in Mahindra and Mahindra. What would be the situation? I would still believe that we still have one basic argument, and which the Gujarat High Court considered in Chetan Chemicals, that the waiver of a loan, I am not in the business of borrowing and lending money. And therefore, waiver of a loan, either from a bank or from a private party, is not arising from the business. And therefore, again, I would believe that even post-amendment, it should not get taxable. However, the department, as usual, we know the practice, and somewhere after a few years, the courts will have to decide these principles. But as the law stands, I would personally believe that it should not get taxable as far as the waiver of a loan is concerned. But as far as interest is concerned, it would always be subject to section 43 capital B and section 41(1), that if it is claimed as a deduction and then it is subsequently waived or returned back, then it would be subject to 41(1) and subject to section 43 capital B. Discount on redemption of the FCCB. The facts before Bombay Tribunal was that the company had issued 100 rupee FCCB bond and it was redeemed at 90. And from the facts, it was evident that this 100 rupee was utilized for the purpose of capex expenditure. And the tribunal took a view that it is not a cash transaction. It is a cash transaction, a waiver of a discount amount, and that it is used for the purpose of capex. It should be taxable. It should not be taxable under section 28(4). Now, post-amendment, what would be the situation? I would personally believe that even if it is used for the purpose of capex, it should be taxable. And the reason which I would believe that hypothetically, I would have issued this FCCB at a premium. The premium would always be deductible under section 37(1). And therefore, conversely, discount would always be a benefit. And I would believe that even under section 28 general principles of law, it should get taxable as far as the discount amount which I get on issue of an FCCB. But again, as I said, this is my personal view, and when somebody can have a slightly different view, and the courts will have to decide at some point of time. The share application money returned back, or a forfeiture of a share application money either on partly paid up shares or a share application money, again, I would believe it should always be on a capital account. It is neither a benefit, it is neither a perquisite, it is again not arising from the business, and it should not get taxable. Employer-employee relationship I have already dealt with earlier, so I am not repeating. Bonus shares and right shares. Again, this issue has arisen more from the circular of the board under 194R. And the board clarifies under 194R circular that bonus or right issue by listed entity, there is no need to do any TDS. Conversely, does it mean that for an unlisted entity, the company in which public are not substantially interested, is it a benefit or a perquisite subject to 28(4) and 194R? My personal view, it is a right of a shareholder to whom it is given. As far as bonus is concerned, it is neither a benefit nor a perquisite. The intrinsic value of my share till yesterday and after the bonus issue remains the same. I am neither benefited nor I have lost anything. I would believe that it should not. As far as right shares are concerned, again, right is given to all the shareholders as a right to subscribe those shares. It is a right given. It is an obligation of the company to offer the shares on a right basis to all the shareholders. And again, I would personally believe that it is again on a capital account. It is neither a benefit or a perquisite. And as far as majority of the shareholders are concerned, it should not be arising from the business. But suppose if there are shareholders who are actually in the business of trading in shares, for them the shares are stock in trade, for them the question would arise. And there the only question I would believe that neither section 194R nor the 28(4) taxability would arise. Allocation of the cost common expenditure. The only question is that you must analyze that is it an allocation of a common cost or there is a service element. If it is a service element, the question would always come a benefit if it is not an arm's length price. But pure allocation of an expenditure. So for example, if somebody has a common accounting services within the same groups, within the same company, for the purpose of 5 different businesses, it is an allocation of a cost. Nobody is rendering services to nobody. There is neither service provider nor service recipient. And therefore there, it again should not arise a benefit or perquisite argument under section 28(4). Interest fee or a concessional rate, again, I would believe it should not be arising unless if the recipient has taken any benefit out of it. If a peculiar fact demonstrates that somebody has taken a benefit out of interest-free loan, otherwise under the real income principles, income cannot be taxable on an interest-free loan. Yes, if I borrowed money and given an interest-free loan, there could be an implications under 36(1)(3), but it cannot be taxable under 28 as far as interest-free loans are concerned. Free maintenance services, again, it is always a part of a contractual obligation. It is inbuilt into my sales price. Even under Ind AS, that maintenance charges are splitted and accounted for over the period of years. And therefore, again, it is neither a benefit or a perquisite. It is a part of my contractual obligation. The same principle should hold good for a zero-cost EMI, that it is again inbuilt into my interest rate. It is only a structuring of a transaction. It's a contractual obligation between the parties, and therefore there is neither a benefit nor a perquisite. It is only a terminology which is being used for the purpose of marketing or for the purpose of promotion of that particular loan scheme. Let me go to 194R. These are general provisions, so I would skip as far as understanding the section. Let me take the such a situation. The memorandum explaining provisions under section 194R provided that certain income which is given in kind are not getting taxed in the hands of the recipient. And one of the reasons was also given to free samples in a pharmaceutical industry, or free gift which are given by the pharmaceutical industry. We are aware of the amendment to section 37(1), including the Supreme Court judgment in Apex Lab, where any incentive, gift, perquisites, etc., given to the doctors, again the medical council guidelines, are not eligible for expenditure under section 37(1) itself. As far as free samples are concerned, my personal view, I am aware that certain pharma companies have already started deducting TDS, either on some basis or even by doing a grossing up. The only question is, where a representation was made by many industries, but government has not considered those suggestions, that free samples do not have a commercial value. It is not for sale in the market. So legally, the doctor or the distributor or whosoever is in possession of free sample cannot sell these in the open market. It has no commercial value. And therefore, if it has no commercial value, it can neither be treated as a benefit or a perquisite. Second challenge, even if a pharma company accounts for as benefits or perquisites and deduct TDS, how would the distributor or the doctor account for in their books of accounts? Would it be at a particular value? I'm aware of the circular of the CBDT which has said that if it is manufactured, then the cost, or if it is purchased and sold, the same price. But how would the doctor or the distributor account for in the books of accounts? Because if I have to take TDS credit under 194R deducted by the pharma company, under 199, I will have to show income. Unless I show income, I may not get a credit. And therefore, I will have to show this as an income. So I will have to first pass an accounting entry as credit profit and loss account and debit inventory. Second entry, I will consume that inventory and show as an expenditure. But what expenditure? What do I do with that? Have I sold to somebody? Answer is no, I cannot sell legally because it is not sellable, it is no commercial value. So the only thing I would have consumed. tomorrow, again, a very extreme argument, which I hope department will not do. But suppose if doctor has used that free sample medicine for that family members and has debited this expenditure to profit and loss account, some tax officer will come and say it's a personal expenditure and therefore not allowable. So I have shown income and the expenditure is not allowable as a deduction as a part of the profit and loss account. Second, what will happen to GST impact? Would it be treated as a supply? And would it be also now subject to, because there is already a value as per the circular. There is already a value for the purpose of TDS. And therefore, would GST also apply as far as this is concerned? Again, with all respect, I don't have an answer on accounting and GST. But these are two practical challenges as far as the free samples and the pharma industry is concerned. And I would believe that the pharma industry would have taken a view on this particular aspect, and all of us will have to understand and learn the accounting and GST impact going forward if I decide to treat this as subject to TDS under Section 194R. Loan settlement, we have already discussed for 28(4) perspective. The circular carves out exception to a banking industry and a non-banking financial company only for the purpose of 194R. It does not give exception to 28(4). And we have already discussed what happens under 28(4). But as far as 194R is concerned, suppose if it is from a related party, a personal loan, unsecured loan, there is no carving out or exception to 194R as per the circular of the board. And therefore the question would arise again that is it subject to TDS under Section 194R? Again, the question is it arising from the business? And the same principles of 28(4) one will have to take this view that it is neither a benefit or a perquisite and arising from the business and therefore not subject to TDS. Write-off of a bad debts. Now, this is a very, very relevant question which everybody raises. My first response to this is that one will have to also understand a difference between a bad debts and a quality issue, commercial issue, quantity issue, shortages, price difference, etc., etc. Normally, a bad debts would be an amount which is written off would be treated as a bad debt if the other party is in financial difficulty and is not able to pay. My experience tells me that in majority of the cases, certain amounts are written off not because other party is financially weak. The amounts are written off because there are commercial issues, quality issue, weight issue, transport issue, the price difference, certain other commercial differences between the parties. If these are made distinction between such issues and a bad debts, the question of treating as a bad debts would substantially get reduced. And therefore, the risk of deducting or not deducting TDS on all these items would also get reduced. But hypothetically, there is a genuine bad debts. And the question is whether do I need to deduct 194R? Again, commercially, I would believe that it is neither a benefit or a perquisite. When I have to recover money from somebody, when I writing off, the other party is not getting any benefit or perquisites. It was a commercial obligation, which because of the financial condition, he is not able to discharge that amount. He is not getting any benefit or perquisites in the course of business for not paying that amount to the other party. And therefore, again, I would believe that it should not be treated as an amount subject to TDS. sales discount, cash discounts, incentive rebates. Question number 4 of the circular defines that even the sales discount, rebates, everything is benefit of perquisite. That is what they exactly say. If I read that particular line, it is interesting. It says, logically, the sales discount, cash discounts, and rebates, though related to sales and purchase, are also benefits. But with a view to avoid practical difficulties in the business, we believe that there is no need to do TDS under section 194R. And then on the next page, they have given an example. And then they say that when a person gives incentive other than discount and rebate in the form of cash or in kind, such as car, TV, computers, gold coin, mobile phones, this would be subject to TDS. Now, question is, what is discount? What is incentive? What is rebate? I would believe that a discount is normally given to all class of customers as a standard practice. That if you buy these goods, the company gives you 10% discount or a 15% discount, which is either given in the invoice or which are either given as a part of the credit note or a debit note, which I would believe the board takes a view that it actually reduces the sales realization and whether, therefore, it should not get covered under 194R. Rebates, as I said, is a very, very general terminology. But I would believe that it all quality issues, quantity issues, price difference, etc., would normally be treated as a rebates. And therefore, the rebates also do not require TDS under 194R. The only question which would arise that if I have a performance incentives, if I have a target incentives, if I have a turnover incentives, etc., whether given in cash through a credit note, would it require 194R? Going by the spirit of and the objective of the law, the answer could be no. But after the amendment of 194R, particularly from 1st April 23, which is assessment year 24-25, I personally would believe that it would fall into 194R, and even in the transaction which are through a credit note in the form of an incentives, performance-based, turnover-based, one would be obliged to do TDS under 194R in addition to incentives given in kind. For last year, which is 1st July 22 to March 23, somebody can take a view because the cash was not covered in 194R. It was not covered in 28.4. You had a Mahindra & Mahindra judgment. You had certain other judgments. And therefore, the incentives in the form of a cash was not covered. But from 1st April 23, personally, I would believe that it should get covered. However, going by the pure spirit, objective of the section, one could take an argument that it is still not covered and only the kind is covered. But I would believe personally that after the amendment, it should get covered. Brand recallers, voucher, coupon, royalty. Whenever it is a transaction between a company and a customer, which is a B2C, it is not arising from the business, and therefore it should not get covered under Section 194R. But if it's through a distributor, retailer, stockist, I would believe that if I sell a particular product and as a part of the product, I give my another product of the same company or the same product, going back to question number 4, I would believe that it is nothing but a lesser realization of the sales. It is a discount. It is not subject to 194R. It is not a benefit of perquisite. But if I am selling a particular X product and as a part of a sales promotion, I purchase Y product from the market and I give it to my distributors, dealers, and retailers as a arising from the business, I would believe that that should fall into the the vouchers, coupons, loyalty points as a part of the incentive schemes, and therefore it should get covered. The same principle of vouchers and coupons, that if I buy certain goods from on the credit card and if I get those points, again, as a customer, it is not arising from the business and that should not get covered. But if it is arising from the business, the same principle should follow. That if, like for example, I go to petrol pump as a distributor and I get points and I can redeem this against the future purchase of a petrol or a diesel, the same product, I would believe it should not, it is nothing but a discount. But if I buy petrol pump and if I accumulate the points and I can go and buy a wristwatch, and if it is arising from the business, the answer would be yes, that it is a benefit or a perquisite arising from the business, and therefore it should get covered. And my personal view is that the government wanted to actually cover such transactions under Section 28(4) and 194R. 194R is basically to cover and to track such expenditure for the purpose of TDS so that the payer gets the benefit of an expenditure, but the recipient also pays the tax so that there is no leakage in revenue. As far as distributors and customers in our supply chain, many times there are challenges, but one should also understand that when you take a view that a distributor is only an agent, then other implications of principal agent should also be kept in mind. Otherwise, yes, I would believe that it would have a cascading effect of TDS and income, because a company would give it to distributor, distributor to stockist, stockist to retailer, and retailer to ultimately a consumer. And therefore, one should also keep this in mind that if it is a principal agent and it is an obligation of the distributor to pass on to a next level in the supply chain, then ultimately only one level TDS should come. I would believe that government should consider, similar to 194J, on a software purchase. To avoid cascading effect, the government had issued a circular that if you have a multiple buyer and seller, you should only make TDS at the first level and the subsequent declaration should be sufficient. Government should consider a similar relaxation for such supply chain. Benefit of perquisite to a government, again, answer is no, and the same principle should get extended to the trust. I would skip these two items and let me take two items, one on reimbursement and other is on the dealers. Komal, I'll just take 3 minutes and finish in by 4:50. As far as reimbursement of expenses are concerned, the circular takes a view that if it is covered under other provisions of the Act, going by the older circular of 95, then there is no need to deduct TDS under 194R, which in my opinion is right. The second view which is being taken is to borrow the principles of principal agent from the GST, and where from the principal agent relationship, the board has taken a view in the circular that if this relationship is established, then there is no need to deduct TDS under 194R. Otherwise, it may arise. Now, the only question is, what is reimbursement? That one should take into consideration. Every expenditure cannot be treated as a reimbursement. Like, for example, as a lawyer, on a fees I charge 10% clerkage. That 10% is not a reimbursement. It's the expense. It's a additional fees I'm covering for the purpose of meeting my expenditure. And therefore, that cannot be treated as a reimbursement. But if it is supported by back-to-back evidences, supported by a contractual obligation, then answer could be yes. But now board has taken a principle of principal-agent relationship also. The next issue is about the dealers conference. And interestingly, the one day before and one day after has now been specifically excluded. But then it goes to say that if it is a group event, if there is a common expenditure, which is in the nature of benefit of perquisite, then if it is possible, if it is impossible to deduct TDS because you are not able to identify the expenditure, then you should disallow voluntarily under Section 37(1). Now, this is again a very extreme view, very narrow view as the government has taken, that Say, for example, if I have a sales meeting in the month of March and January, in the month of April, and then you have certain group events. You have certain events for gaming to bring the team together, to bring motivation, certain common events. All these events is actually a part of employees' development. It is not for the purpose of benefit of Perquisite. It is for their motivation. It is for their benefit, so that they are able to perform better. In those circumstances, I would believe that it should not be treated as benefit of Perquisite. Last issue on grossing up. The board has taken a view in that if the company decides to bear the TDS expenditure, then it should be grossed up. A very, very academic, theoretical view somebody can take. Should I be grossing up tax to tax to tax in a multiple times? I would believe that we have a similar principle under 195 capital A, where a tax is borne by the Indian payer. It is grossed up only once, and it need not be grossed up multiple times. And I would believe that that principle should hold good as far as 194R is also concerned. Last issue on right and bonus shares, we have already taken considered as far as the 28.4 is concerned. I would believe that in the 50 minutes time, reasonably, I've been able to cover reasonably well. And if you have any questions, if you have any suggestions, happy to interact with all of you.